All right, welcome back everyone for another deep dive. Today we're tackling One Up on Wall Street by Peter Lynch. Now, for anyone who's not familiar with him,
hmm
Peter Lynch is basically a Wall Street legend.
Yeah,
He ran the Fidelity Magellan Fund and turned it into like a massive success story.
huge. Yeah.
And in this book, he kind of lays out his whole investment philosophy, his strategies,
Yep.
and it's written in a way that's, really engaging, approachable,
Yeah.
and even funny at times.
Absolutely. He's got that great conversational style, but he doesn't shy away from, the tough stuff.
Exactly. And that's what we're here for today, to dig into some of those timeless investing lessons that Lynch shares.
Yep, the stuff that can help anyone become a smarter, more confident investor.
Right from the get-go, Lynch really gets you thinking. He starts talking about the importance of fundamentals.
Uh-huh.
But he does it in a way that kind of makes you chuckle. He says, focusing on fundamentals in the age of all these internet stocks
Right.
might make him sound like, an old-fashioned investor.
Yeah, bit old hat.
Exactly. But then he goes on to explain why, even with all these exciting new technologies and companies popping up, ignoring the fundamentals
Uh-huh.
is a huge mistake.
Yeah, it's like building a house on sand, you
Yeah.
know?
And he has this great anecdote about the dot-com bubble. Do you remember all those Maserati dealerships that were like
Oh, yeah.
popping up all over Silicon Valley?
Like overnight?
It was crazy. Everyone was just so caught up in the hype,
Uh-huh.
and they were paying these insane prices for companies that hadn't even really proven themselves yet.
It was all about potential. Right. Not actual performance.
Right. And then, boom, the bubble bursts.
Yeah.
Those Maseratis gone. And a lot of people's fortunes went with them.
Ouch.
So, I mean, is Lynch saying we should, like, totally ignore the next big thing? I mean, some of those tech companies
Sure.
did end up, changing the world.
Right. He's not saying ignore them completely, but he is saying be careful, Don't get so swept up in the excitement
Right.
that you forget to look under the hood.
So it's about due diligence.
Yeah, he's all about
Right.
finding value, not just chasing hype, And to illustrate this, he goes into this whole story of Microsoft's rise to power.
Oh, yeah, Microsoft.
Yeah.
And I love that analogy he uses, the whole gas and boxes thing.
Yeah, that's a classic Lynch bit. He's talking about the concept of niches, right?
Right. So explain that a little bit.
So basically, Microsoft didn't just create like a great product. They created something that was essential. Like
Mhm.
the software that ran the entire PC ecosystem. Their operating system, Windows, became the gas
Right.
that everyone needed to run their boxes, the computers.
So they kind of cornered the market.
Yeah, and that's what fueled their incredible growth. It was
Mhm.
that control over a crucial niche.
So finding those niche dominators, that's something investors should be looking for.
Absolutely. Companies that have a product or a service that's just indispensable to their customers.
Okay, so it makes sense, right? You wouldn't buy a car without an engine.
Exactly.
And Microsoft basically made sure they were the only game in town when it came to providing the engine for the personal computer.
Yeah. But even with the best companies, even those niche dominators, there's always the risk of the market going up and down.
Oh, yeah. The market can be so unpredictable. How do you deal with that?
That's a key point. And Lynch doesn't shy away from it. He talks about market volatility, how the market goes up and down,
Uh-huh.
And he uses this example of the Nifty 50. You familiar with those?
Vaguely, remind me.
So these were like the blue chip stocks of the 1970s.
Okay.
The companies everyone thought were just guaranteed to grow forever. They were the giants of their day.
Right.
And then the market corrected. And guess what happened to those safe stocks?
What?
They took a huge hit.
Really? Even those big established companies?
Some of them never fully recovered.
Yeah. So even if you pick a great company, you're not immune to these market swings.
And Lynch's point is that these corrections are inevitable. They're
Yeah.
a natural part of the cycle. Because corrections like drops of 10% or more.
Yeah.
They happen every couple of years.
Yeah.
And the bigger crashes, the bear markets,
Right.
those happen roughly every 6 years.
So if these downturns are practically guaranteed, I mean, how do you not panic and sell everything when things start going south?
That's where Lynch's philosophy of long-term investing comes in. He says, you don't have to, and you shouldn't, try to time the market. He wants you to understand that. And he uses this amazing example to show the power of long-term investing, even through all those ups and downs.
Okay, I'm listening.
Imagine you invested $1,000 in stocks back in 1927.
Wow, that's going way back.
It is. But here's the thing. Even after all the crashes and depressions and wars and recessions over the next 60 years,
Yeah.
that $1,000 invested in stocks would have grown way more than if you'd put it in bonds or treasury bills.
Wow, that's pretty convincing. So basically, write out those dips.
Right.
Don't panic. Trust in the long-term growth.
Exactly. And that long-term perspective ties into another key point Lynch makes about compounding.
Okay.
He wants you to think about it like a snowball rolling downhill, right?
Yeah.
It gets bigger and bigger over time.
Yeah.
And the longer you let it roll, the more massive it becomes.
So slow and steady wins the race, huh?
Yeah. But before you rush out to buy stocks, Lynch has what he calls a mirror test for us. He wants you to ask yourself some tough questions.
Okay. Hit me with these questions. What's the first one?
Well, the first one might seem a little strange.
Okay.
He asks, do you own a house?
Owning a house. What does that have to do with investing in stocks?
He's a big believer in home ownership.
Yeah.
He sees it as like a foundational investment for most people.
Right. It's a long-term commitment.
Exactly. And he wants you to apply that same mindset to your stock portfolio.
So just like you don't panic and sell your house every time the housing market dips.
Exactly.
You don't do the same with your stocks when the market takes a tumble.
Right. Don't make rash decisions based on short-term fluctuations.
Okay. That's a good analogy. What's the second question in this mirror test?
The second one is about responsibility.
Yeah.
Do I need the money?
Okay, that makes sense. Don't invest money you can't afford to lose, right?
Right. Don't gamble with money you'll need for bills or tuition or anything like that. Only invest what you can afford to let ride.
Right. That's responsible investing.
Yeah. And then the third question gets more into the psychology of investing,
Let's hear it.
He asks, do I have the personal qualities it takes to succeed in stocks?
So it's not just about being smart.
It's about temperament.
Uh-huh.
He lists a bunch of qualities.
Like what?
Patience, self-reliance, common sense, tolerance for pain, an open mind,
Oh, wow.
detachment, persistence, humility, flexibility, willingness to do independent research, all these things.
So it's really about having the right mindset.
Yeah, the right temperament.
Yeah. And being able to learn from your mistakes, I imagine that's up there too, right?
Absolutely. Lynch doesn't want us to think of investing as like a get-rich-quick scheme.
Right.
He's emphasizing that it's about making informed decisions, managing risk, and staying the course, even when it gets tough.
So it's like a marathon, not a sprint.
Yeah. And you know what? He actually compares investing to playing poker.
Oh, I remember that.
Specifically, 7-card stud. He says the stock market, like poker, involves chance.
Uh-huh.
But with knowledge and skill, you can tilt the odds in your favor.
So you're choosing your battles wisely, picking good cards.
Exactly. Know when to hold them, know when to fold them.
Okay, I like that.
But ultimately, it's about playing the long game, just like a poker tournament.
And this leads perfectly into another one of Lynch's big points, right?
Oh, yeah.
Invest in companies, not in the market.
Yeah. What do you think he means by that?
I think he's saying, look beyond all the short-term noise and hype and focus on the fundamentals of great businesses.
Exactly. He thinks a lot of investors get caught up trying to time the market, chasing the hottest stock, or panicking when things dip.
Right.
He says, forget about all that. Focus on the long-term potential of solid companies.
Okay, so tune out the daily chatter and look at the bigger picture.
Exactly. And he uses this example from the steel industry
Okay.
to prove his point. Even if you correctly predicted that the steel industry was going to rebound, picking the right company within that industry made all the difference in your returns.
Ah, so it's not just about betting on the right industry, it's about picking the winners within that industry.
Precisely. He's all about doing your homework and understanding the nuances of each company.
It's about going deeper, doing the research.
Yeah, he doesn't want you to be a passive investor. He wants you to be active, informed.
This is really resonating with me. So how do we actually find these winning companies, the ones that are going to deliver those 10-bagger returns that Lynch is famous for?
10 baggers, right?
Yeah. Are we talking about complicated algorithms or like insider information? What's the secret?
Well, one of the great things about Lynch's approach is that he thinks the average person has a real advantage here.
Really? What's our advantage?
Our everyday experiences.
What do you mean?
He argues that we're often exposed to interesting products and companies years before Wall Street catches on.
So just by living our lives, we're gathering valuable information.
Exactly. You just have to open your eyes and pay attention to what's happening around you.
Mm.
Think about The Gap, for example. Back in the 70s, it was just a small chain of jeans stores.
I vaguely remember that.
Imagine you walked into The Gap in 1976. You could buy 10 pairs of jeans for $180.
Okay.
Or you could buy 10 shares of Gap stock for roughly the same price.
Interesting.
Which one would be worth more today?
I think I know the answer to that. Those jeans would be long gone. But the stock,
At its peak, those 10 shares would have been worth over $4,600.
that's incredible. So those everyday observations can actually give us a leg up in the market.
Exactly. He talks about La Quinta Motor Inns, too. Back in 1973, you could have stayed at a La Quinta for 31 nights, spending about $180.
Okay.
Or you could take that same $180 and buy some La Quinta stock. 10 years later, guess which one's worth more?
I'm sensing a pattern here. I'm guessing the stock was a better investment than a month of motel stays.
You got it. Those shares would have been worth over $4,300 after a decade.
So we need to be more like detectives,
Yeah.
looking for clues in our everyday lives.
Think about the products you use, the stores you frequent. Are there any companies behind those everyday experiences that are doing well, expanding?
Okay, I'm starting to get it, but the market is so vast. How do we even begin to make sense of it all? There are so many different types of companies and investments out there.
That's where Lynch's categorization of stocks comes in. He breaks down the investment universe into 6 distinct categories,
Okay, 6 categories. This sounds helpful.
each with its own characteristics, risks, and potential rewards.
All right, I'm ready to hear about these categories. Let's break them down and see if we can find some future 10 baggers lurking among them.
Sounds good to me.
What's the first category on Lynch's list?
First up, we have the slow growers. Think big, established companies that are known for their stability more than anything else. Like utility companies are a classic example.
Okay, so not the most exciting, but, dependable.
Right. They might not make you rich quickly, but they offer steady income.
What should we look for in a slow grower then?
Look for consistent earnings growth. It might be modest, but it should be there. They often pay dividends too.
Dividends, those are good if you're looking for a regular income stream.
Exactly. The key is to buy them at a reasonable price and be realistic about their growth potential.
Got it. Slow and steady, but make sure you're not overpaying. What's
Okay.
the next category on the list?
Next, we have the stalwarts.
Stalwarts, okay.
These are large, well-known companies with a proven track record.
Oh, so like the blue chips. Companies like, I don't know, Coca-Cola, Procter & Gamble.
Yeah, those are good examples. They've been around forever and probably will be for a long time to come.
And they tend to be less volatile than, some of those smaller, faster-growing companies.
Exactly.
So a bit more stability for investors who are, maybe a little more risk-averse.
Right. Stalwarts can be solid investments, but they're not likely to be 10-baggers. You might see a nice double or triple in your money over time, but you won't see those explosive returns that you might get with other types of companies.
Okay, so buy at the right price, hold for the long term, enjoy the stability.
Yeah, that's the general idea.
Okay, now for the category I'm most intrigued by, the fast growers. These are the ones with the potential to really take off, right?
They are. Fast growers are companies that are expanding rapidly,
How rapidly are we talking?
often at a rate of 20 to 25% a year or even more.
Wow, that's fast.
Yeah, and they're usually smaller companies, in the early stages of their growth cycle.
It's like, think Amazon or Google in their early days.
Exactly. They were growing at an incredible pace, and their stock prices were reflecting that growth.
So how do we spot these future Amazons and Googles before everyone else does?
That's the million-dollar question, right? The challenge with fast growers is figuring out which ones can sustain that rapid growth.
Right, right.
A lot of them hit a wall eventually, Maybe the market gets saturated, or they just become victims of their own success.
So it's not just about finding a company that's growing quickly. It's about finding one that has a sustainable advantage, a unique product or service, a strong management team, all of that.
Exactly. It takes a bit more digging to determine if a fast grower has what it takes to be a long-term winner.
All right, on to the next category then. We've got cyclicals.
Cyclicals, yeah. These are the companies that are more tied to the ups and downs of the economy.
Right, like the companies that do well when the economy's booming and then struggle when things slow down.
Exactly. Industries like automobiles, airlines, housing, these are classic examples of cyclicals.
So it seems like investing in cyclicals requires a bit of market timing, knowing when to get in and when to get out.
You got it. You want to buy cyclicals when they're out of favor
Uh-huh.
and the price is low, and then sell them when they're riding high on that economic wave.
Buy low, sell high. That's the goal with any investment, right?
It is, but it's especially important with cyclicals.
Okay, what about turnarounds? What are those all about?
Turnarounds are companies that have been through a rough patch but are taking steps to improve,
Yeah.
to, get back on track.
So it could be a company that made some bad decisions or faced some tough competition.
Right, or maybe they were hit hard by a recession, something like that.
So there's definitely an element of risk there,
Yeah,
but also the potential for big rewards if the turnaround is successful.
exactly. The key is to look for companies that have a viable plan for recovery and a strong management team to execute that plan.
Okay, so you're not just betting on a comeback. You're looking for signs that the company is actually making the right moves.
Right, you got to look at their financials, their debt levels, their cash flow. Can they actually make it through this turnaround?
So it's like a patient in the hospital.
Okay, I like that.
You want to make sure the doctor has a good plan and the patient is strong enough to recover.
Yeah, and that there are enough resources to see the treatment through.
All right, we've got one more category to cover: asset plays.
Asset plays. These are companies that have valuable assets that aren't fully reflected in their stock price.
So it's like finding hidden treasure on the balance sheet.
That's a good way to put it. These assets could be anything from real estate to patents to just a pile of cash sitting in the bank.
Okay, so the goal is to buy the stock at a price that's lower than the value of those assets.
Exactly. Creates a margin of safety for you and the potential for some really nice gains if those assets are eventually, realized or appreciated.
That's interesting, but it sounds a bit more complex than the other categories.
It can be. Asset plays can be illiquid, which means it might be hard to buy or sell the stock quickly.
Right, right.
And it could take time for the value of those assets to be unlocked.
So patience is key with asset plays.
Absolutely.
Okay, so we've got our 6 categories. That's a really helpful way to start thinking about the different types of companies out there.
And remember, companies can transition between these categories over time, right?
Oh, that's a good point. So like a fast grower could eventually slow down and become a stalwart, or a cyclical could go through a turnaround and emerge as a fast grower again.
Exactly. Companies evolve, industries shift, the market's always changing.
So we need to be adaptable, always reevaluating our investments.
Precisely.
Okay, so we've got our categories, but how do we know which companies within those categories are actually worth investing in?
That's where Lynch's idea of the perfect company comes in.
The perfect company. All right, tell me more. What are some of the traits of this ideal company?
Well, one of the most surprising traits might be a dull or odd name.
A dull name? Really? That doesn't sound very exciting.
That's kind of the point. Lynch believes those companies tend to fly under Wall Street's radar.
Ah, so they're quietly making money without attracting a lot of attention.
Exactly. He gives some good examples in the book. Crown, Cork, and Seal. They make cans and bottle caps. Not very glamorous, but it's a steady, profitable business.
Okay, I see his point.
Or Service Corporation International, the largest funeral home company in the world.
Not exactly a dinner table conversation topic.
Right, but it's a necessary service, and the demand is always going to be there.
Okay, so we're looking for those under-the-radar companies.
Yeah, the ones that are just quietly generating cash.
What else is on Lynch's checklist for this perfect company?
We also like spin-offs.
Spin-offs. Remind me what those are again.
Companies that have been separated from their parent companies.
Right, right.
He thinks they're often well-positioned for success because they have a clean balance sheet and they're free from all the bureaucracy.
They also often have a new management team that's eager to prove themselves.
Exactly.
So they might be more innovative, more focused on growth.
Yeah, and then there's niches, which we talked about earlier.
Right, those companies that dominate a specific market.
Lynch loves those.
And then there's insider buying and companies buying back shares.
Those are two things that Lynch sees as really positive signals.
Okay, break those down for me. What's the significance of insider buying?
So when a company's own executives and directors are buying shares, that's a good sign that they believe in the company's future.
They're putting their money where their mouth is.
Exactly. It's a vote of confidence.
And what about share buybacks?
That's when a company uses its own cash to buy back its shares.
Okay.
It's a way to boost earnings per share and increase the value of the remaining shares. Lynch sees it as a good sign that the company thinks its stock is undervalued.
So both insider buying and share buybacks can be seen as positive signals.
Yeah, but remember, none of these characteristics are guarantees.
Right, they're just clues.
They're just pieces of the puzzle that help you build a stronger case for investing in a particular company.
All right, so we've got our categories, we've got our perfect company checklist. Now it's time to get down to the numbers. How do we actually evaluate a company's financial performance and decide if it's a good investment?
That's where the fundamentals really come in. And for Lynch, it all starts with earnings.
Earnings. That's just a fancy word for profits, right?
It is. But Lynch stresses that earnings growth is what drives stock price appreciation. It doesn't matter how exciting a company's story is. If they're not making money, the stock's not going to go up in value.
Okay, that makes sense. So how do we actually analyze a company's earnings? What are we looking for?
First, you want to look at the trend of earnings growth.
Okay, so are earnings consistently increasing year over year?
Right, or are they stagnant, declining? What's the pattern?
Got it. A consistent upward trend is a good sign.
Yep. You also want to look at the quality of those earnings.
A quality.
Are those earnings coming from sustainable sources, growing sales, increased efficiency?
Okay.
Or are they coming from one-time events, accounting gimmicks?
So we're looking for real sustainable growth, not just smoke and mirrors.
Exactly. And then there's the price-to-earnings ratio, or the PE ratio.
I've heard of the PE ratio, but I'm not sure I fully understand it. Can you explain it?
Sure. The PE ratio compares a company's stock price to its earnings per share. It basically tells you how much investors are willing to pay for each dollar of a company's earnings.
Okay.
A high PE ratio could mean investors have high expectations for future earnings growth.
Right.
But it can also be a sign that the stock is just overpriced.
So a low PE ratio means the stock is a bargain.
Not necessarily. A low PE ratio could mean investors are pessimistic about the company's future. Or it could just mean that the company's undervalued.
So the PE ratio is just one data point.
Right, you have to look at it in context with other factors.
Like the company's growth prospects, their debt levels, industry trends, all that.
Exactly. Lynch warns against getting too caught up in PE ratios because they can be misleading. He argues that it's more important to understand the story behind the numbers.
So it's not just about crunching numbers, it's about understanding what those numbers actually mean.
Precisely. Which brings us to Lynch's kicking the tires philosophy.
The kicking the tires.
Yeah, he believes the best way to understand a company is to go beyond the numbers, do some real-world research.
I like that. What exactly does kicking the tires involve?
It means talking to your broker, calling the company directly, talking to their investor relations people, visiting their headquarters even.
Wow, so like getting out there and really seeing the company firsthand.
And then do some grassroots research too.
What does that mean?
Talk to customers, employees, even competitors.
Oh, that's a great idea. You get a much better feel for the company that way.
Yeah, Lynch thinks this type of research can give you an edge.
Yeah, you're not just looking at a spreadsheet. You're actually out there talking to people, seeing how the company operates in the real world.
Exactly.
All right, I'm ready to start kicking some tires. But before we do, are there any other financial metrics that Lynch thinks we should be paying close attention to?
He really likes companies with strong cash positions.
Cash. Why is cash so important?
Well, he sees it as a sign of financial health and flexibility. A company with a lot of cash on hand is better positioned to weather economic storms,
Makes sense. They have that cushion to fall back on.
Exactly. They can invest in new opportunities, buy back shares, pay dividends, all that.
It's like having a rainy day fund, but for a company.
He uses the example of Ford.
Okay.
Their large cash hoard actually helped support their stock price, even when analysts weren't very optimistic about the company.
Interesting. So that cash can really make a difference. What about book value? Is that something we need to pay attention to?
Book value is basically the value of a company's assets minus its liabilities.
Okay.
It's a measure of what the company would be worth if it were liquidated today.
Okay.
But Lynch cautions that book value can be misleading. It doesn't always reflect the true worth of a company's assets.
So again, we need to understand what those numbers are actually telling us.
Right. Are those assets really valuable? Are they outdated? Difficult to sell?
So there's more to the story than just looking at the book value.
Exactly. You got to dig a little deeper.
All right. So we've talked about the characteristics of winning companies. We've looked at earnings, cash, book value. Now let's talk about the flip side. What are some red flags that should make us run for the hills?
Lynch has a whole list of investment traps that he calls red flags.
Okay, let's hear about these red flags so we can avoid them. What's the first one?
Well, first up are what he calls whisper stocks. These are companies with really exciting stories, but not much substance to back them up.
Ah, yes, the companies that promise to revolutionize the world, but can't seem to turn a profit.
They rely on hype and rumors to pump up their stock price. Steer clear of those.
What's the next red flag to watch out for?
Diversifications. This is when companies go on these crazy acquisition sprees.
Buying up businesses left and right?
Yeah, but the problem is These acquisitions are often outside the company's core competency.
Right, so they're trying to be everything to everyone and ending up doing nothing well.
Exactly. These acquisitions often destroy value instead of creating it. Be careful of companies that are trying to build empires instead of focusing on what they do best.
Okay, and of course we can't forget those hot stocks in hot industries that we talked about earlier.
Those are the ones everyone is talking about, pouring money into.
Yeah, but their valuations can get so inflated, and they often flame out pretty quickly.
Remember those Maseratis?
Oh, yeah, that's a great analogy. Better to be late to the party than show up early and overpay.
Exactly. And then there are those common investor fallacies that Lynch warns us about. Well, two of the most common are, it can't go much lower, and eventually they always come back.
I've definitely heard those before. People see a stock that has taken a beating and they think it's hit bottom.
But there's no guarantee of that. A stock can keep falling further than you ever imagined.
And as for stocks always coming back, that's not always true either, is it?
Nope. Some companies go bankrupt, some just fade away, and some just muddle along for years, never really regaining their lost ground.
So we have to be realistic and know when to cut our losses.
Absolutely.
Lynch also touches on some of those more complex financial instruments out there.
Yeah, like futures and options.
What's his take on those?
He's pretty critical of them. He thinks they're just too risky for the average investor.
So he's saying stick to the basics.
Yeah, the stuff we can understand and control, picking good companies, holding them for the long term.
Right, but even with a long-term strategy, there comes a time when we need to sell, right?
Yeah.
How do we know when to let go of a stock?
Lynch says it's important to have a selling plan. Lynch says it's important to have a selling plan for each category of stock.
Okay, so our approach to selling should be different depending on the type of company we're invested in.
Right. Your strategy for a slow grower is going to be different from your strategy for a fast grower, or a turnaround, or any of the others.
Makes sense. You wouldn't apply the same rules to every company. So what are some general guidelines for knowing when to sell?
He offers some specific signals, but I think one of the most important is to constantly reevaluate your investment thesis.
Your investment thesis.
Yeah, like why did you buy the stock in the first place?
Okay, so the reasons I bought the stock.
Are those reasons still valid? Have things changed?
Interesting. So even if the stock price has gone up, if the original reasons for buying it are no longer there,
Right.
it might be time to sell.
Exactly. Don't fall in love with your stocks.
Yeah.
Be objective,
Right. It's about making rational decisions, not emotional ones.
He also says that if the company's earnings growth starts to slow down,
Uh-huh.
that could be a sign that it's time to reevaluate.
So pay attention to those earnings reports.
And if management makes a major blunder, that's another thing to watch out for.
Okay, so stay informed. Look for those early warning signs.
Yeah. And remember, even the best investors make mistakes.
That's true.
The key is to learn from them and have a plan for when to cut your losses.
Okay, so we've covered a lot of ground. We talked about the fundamentals, the different types of companies, those red flags, those selling strategies.
It's a lot to take in.
It is. But as we wrap up this deep dive into Peter Lynch's one-up on Wall Street, what are some of the key takeaways that we should really remember?
I think one of the most important is his emphasis on independent thinking.
Independent thinking.
Yeah, he wants investors to trust their own research and insights.
So don't just blindly follow the crowd.
Exactly. He wants you to question assumptions, challenge conventional wisdom, all of that.
That can be tough, especially in a world where we're constantly being bombarded with information and opinions.
It is, but it's so important. And Lynch actually argues that having too much information can be a disadvantage.
Really?
Yeah, he thinks the average investor often has an edge over the professionals
How so?
because they're not overwhelmed by the same level of data and analysis,
So sometimes less is more.
Yeah, it's about focusing on the key factors.
The fundamentals.
Right, and not getting lost in the weeds. He also encourages you to be skeptical of the financial media.
Oh, yes. Don't get me started on those financial news headlines. They can be so misleading.
Exactly. Lynch advocates for a more grounded approach to investing, more common sense.
I like that. So it's not about having some fancy degree or being a Wall Street insider. It's about using your own judgment.
He really believes that the average person can achieve success in the stock market.
That's encouraging.
Yeah, by paying attention to the world around them, doing their research, and thinking for themselves.
And that's what this deep dive has been all about, right?
Oh.
Giving you the tools and the confidence to make your own informed investment decisions.
Exactly.
We covered a lot today. From understanding those fundamentals to recognizing those different types of companies, the red flags to watch out for, the importance of a long-term perspective.
Yeah, we even talked about those common investor fallacies to avoid and how to develop a solid selling strategy.
But I think the biggest takeaway is this. Investing is not some mysterious or exclusive pursuit.
It's accessible to anyone.
As long as you're willing to learn, use a bit of common sense, and have some patience.
Absolutely.
Well, with that, I think we've reached the end of our deep dive into Peter Lynch's One-Up on Wall Street.
It's been a great discussion.
It has. I hope everyone listening has enjoyed this exploration of Lynch's ideas and that they'll continue to learn and develop their own investment philosophy.
Remember, the stock market doesn't exist.
Focus on finding great companies.
And happy investing. Lynch says it's important to have a selling plan for each category of stock.
Okay, so our approach to selling should be different depending on the type of company we're invested in.
Right? Your strategy for a slow grower is going to be different from your strategy for a fast grower or a turnaround or any of the others.
Makes sense.
Yeah.
You wouldn't apply the same rules to every company. So what are some general guidelines for knowing when to sell?
He offers some specific signals, but I think one of the most important is to constantly reevaluate your investment thesis.
Your investment thesis.
Yeah, like why did you buy the stock in the first place?
Okay, so the reasons I bought the stock.
Are those reasons still valid? Have things changed?
Interesting. So even if the stock price has gone up, if the original reasons for buying it are no longer there,
Right.
it might be time to sell.
Exactly. Don't fall in love with your stocks.
Yeah.
Be objective, you know.
Right. It's about making rational decisions, not emotional ones.
He also says that if the company's earnings growth starts to slow down, that could be a sign that it's time to reevaluate.
So pay attention to those earnings reports.
And if management makes a major blunder, that's another thing to watch out for.
Okay, so stay informed, look for those early warning signs.
Yeah, and remember, even the best investors make mistakes.
That's true.
The key is to learn from them and have a plan for when to cut your losses.
Okay, so we've covered a lot of ground. We talked about the fundamentals, the different types of companies, those red flags, the selling strategies.
It's a lot to take in.
It is.
Yeah.
But as we wrap up this deep dive into Peter Lynch's One-Up on Wall Street, what are some of the key takeaways that we should really remember?
I think one of the most important is his emphasis on independent thinking.
Independent thinking.
Yeah, he wants investors to trust their own research and insights.
So don't just blindly follow the crowd.
Exactly. He wants you to question assumptions, challenge conventional wisdom, all of that.
That can be tough, especially in a world where we're constantly being bombarded with information and opinions.
It is, but it's so important. And Lynch actually argues that having too much information can be a disadvantage.
Really?
Yeah. He thinks the average investor often has an edge over the professionals
How so?
because they're not overwhelmed by the same level of data and analysis, you know.
So sometimes less is more.
Yeah, it's about focusing on the key factors.
The fundamentals.
Right, and not getting lost in the weeds. He also encourages you to be skeptical of the financial media.
Oh, yes. Don't get me started on those financial news headlines. They can be so misleading.
Exactly. Lynch advocates for a more grounded approach to investing, more common sense.
I like that. So it's not about having some fancy degree or being a Wall Street insider. It's about using your own judgment.
He really believes that the average person can achieve success in the stock market.
That's encouraging.
Yeah, by paying attention to the world around them, doing their research and thinking for themselves.
And that's what this deep dive has been all about, right? Giving you the tools and the confidence to make your own informed investment decisions.
Exactly.
We covered a lot today, from understanding those fundamentals to recognizing those different types of companies, the red flags, to watch out for the importance of a long-term perspective.
Yeah, we even talked about those common investor fallacies to avoid and how to develop a solid selling strategy.
But I think the biggest takeaway is this. Investing is not some mysterious or exclusive pursuit.
It's accessible to anyone.
As long as you're willing to learn, use a bit of common sense, and have some patience.
Absolutely.
Well, with that, I think we've reached the end of our deep dive into Peter Lynch's One-Up on Wall Street.
It's been a great discussion.
It has. I hope everyone listening has enjoyed this exploration of Lynch's ideas and that they'll continue to learn and develop their own investment philosophy.
Remember, the stock market doesn't exist.
Focus on finding great companies.
And happy investing.
That's it for today. Thanks for joining us.